Hey mum, have you seen my wallet? How much was in there? Just $65 trillion. Holy flippity flip flop flapping smokes, everyone. $65 trillion has all of a sudden gone, evaporated without a trace. So, what are these central bankers doing with our money? Where has our money gone? This is absolutely crazy, everyone. And I think if this money does not get accounted for, this is going to create another global financial crisis. Or could have this money been taken? Because I don't think you can just accidentally lose $65 trillion like that. I can understand if you lose a bit of chump change underneath the couch cushion, but you're not just going to, all of a sudden stumble over $65 trillion or not see it missing on your books when you do your accounting check. So everyone, this is either the biggest accounting muck up in history, or this is going to go down as the biggest fraud in history, much bigger than FTX. So let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Well, look at this, everyone. Huge, missing, and growing. $65 trillion in dollar debt sparks concern. Yeah, I don't know about you, but I'd be a bit concerned too. There's a hidden risk to the global financial system embedded in the $65 trillion debt being held by non-US institutions via currency derivatives, according to the Bank of International Settlement. Now, I've talked about the Bank of International Settlements on this channel before, short for BIS. And we've also talked about toxic derivatives and how I think the next financial crisis is going to be caused by these derivatives imploding. Because people, you thought money was nothing or you thought it had no value. Well, there's derivatives that aren't even backed by money that has no value. And now the derivatives market has got so crazy, these central banks are losing control. In a paper with the title Huge, Missing and Growing, the BIS said a lack of information is making it harder for policymakers to anticipate the next financial crisis. Wow, so they're starting to admit it now, everyone. They raised concern with the fact that debt is going unrecorded on balance sheets because of accounting conventions on how to track derivative positions. What? Did you hear that, everyone? This debt is going unrecorded on the central banks and the bank's balance sheet. I wonder why. Probably because if they recorded on their balance sheet, they would be negative. The banks would appear as insolvent because they would have negative equity, so now they're trying to cover it up. The findings, based on data from a survey of global currency markets earlier this year, offer a rare insight into the scale of hidden leverage. Ooh, we're starting to uncover some conspiracy theories here with some hidden leverage secret money people. Foreign exchange swaps were a flashpoint during the global financial crisis of 2008 and the pandemic of 2020, when dollar funding stress forced central banks to step in to help struggling borrowers. To be sure, the debt is backed by an equivalent amount of hard currency. To understand how the system works, consider a Dutch pension fund buying assets in the US. As part of that transaction, it will often use a foreign currency swap to exchange euros for dollars. Then when it's closed out, the fund will repay the dollars and receive euros for the length of the trade. The payment obligation is recorded off balance sheet, which the BIS calls a blind spot in the financial system. Well, we saw how it worked out in 2008 with all these swaps and all these derivatives and how it ended up there. Well, I think the same thing is going to happen again during this market crash in 2023. And BIS saying that's putting policymakers at a disadvantage. It's not even clear how many analysts are aware of the existence of the large off-balance sheet obligations, they wrote. In times of crisis, policies to restore the smooth flow of short-term dollars in the financial system, for instance, central bank swap lines, are set in a fog. Now, also what a lot of people don't understand is, it can get very complicated. To put it very simply, is money isn't always printed. When they say we're printing money, a lot of it is swaps with central banks and commercial banks on their balance sheets. They just take an asset and then they'll swap it with an IOU. It's not actually currency being created. And it just shows you how money's not real. It's kind of like the man on The Wizard of Oz, behind the curtain. He's pulling all the strings, making it look like the system's working, when really, when you look at the core of the system, it is not working and it is not real money. Central banks have found ways to manage the demand for dollars during times of stress. The Federal Reserve has tools such as swap lines and the FEMA report repo facility to help prevent markets from seizing up. That's right, everyone. We got the reverse repo markets here. We can see the banks are parking $2 trillion every single day at the Federal Reserve, and they're getting, 3% interest on their money. For researchers at the BIS, it's the sheer scale of swaps that's worrying. They estimate that banks headquartered outside the US carry $39 trillion of this debt, more than double their on-balance sheet obligations and 10 times their capital. So again, like I've been warning everyone, not only they take your money and they lend it out 10 times, they have 10 times more derivatives off their balance sheet that they're not telling you about. They're trying to tell us that the banks are safe, the banks are fine. No, people, if these are derivatives, if these debt assets, if they implode, the whole system is going to come crumbling down. It may seem like crazy alarmist, but it is what's going to happen eventually. There is a staggering volume of off-balance sheet dollar debt that is partly hidden, and the FX risk settlement remains stubbornly high. So again, people, it's not me being alarmist here. These analysts are warning that the risk of something going bad is extremely high. In a separate report on Monday, the BIS also flagged the settlement risk as another potential source of instability in the foreign exchange market. Researchers estimate that 2.2 trillion of daily currency turnover was subject to settlement risk, the possibility that one party to a trade fails to deliver the asset. Payment versus payment arrangements, a settlement mechanism that coordinates transfers to ensure no one is left holding a claim, tend to be unsuitable or too expensive for certain trades, the BIS paper said. There's clearly an urgent need for wholesale market participants to look for alternative ways to eradicate settlement risk exposure across a broad range of currencies outside of the traditional majors, said Jerome Kemp, president at the post-trade processing firm Batten Systems, in a response to the paper. Well, ladies and gentlemen, this is an absolute bombshell report. And it is showing us again and again and again that the banks are not safe. The banks are not strong. The Federal Reserve keeps telling us how strong the banking institution is. People, I think this is just the tip of the iceberg. I think there's actually more like hundreds of trillions of dollars of assets or of off-balance sheet trades or deals that are going on that we don't even know about. And just like in 2008, we only find out how bad it really is once the crisis hits. Like a Ponzi scheme, when the money's coming in, everything looks great, but it's only once the Ponzi falls, then that's where you see the fraud exposed. So again, like I've been warning, you may not want to have all your money in one bank, because what happens if one of your banks get hit by this? This is why you want to at least diversify your bank accounts and have some cash on hand, because people, these banks are gambling your money away hand over fist. But everyone, what do you think about this report? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.